Hey there. When I was thinking about this video and how to convey the idea of what I'd like to share with you, I was thinking, how do I do that? That's why I walked through the door. We're in a new stage of the business cycle. The room we were in, I was in that room before. Now I'm in this room. The economy is in the same situation. We were here, now we're here. We're in a different stage. Interest rates have risen to this level, almost 5%. We may have one more of those, maybe two, but we said that a couple of months ago. We're at the end of this rate rising cycle, or nearing the end, which puts us at a different stage of the business cycle. Now, as you know, we watch what's going on in the bond market and the business cycle. This is an important time for the economy. A couple of things have happened recently that have changed that a little bit. If you've been watching the news in the last 3 or 4 weeks, you've seen the banking situation. Been a couple banks that have gotten into trouble and failed. You've also seen that the U.S. Treasury has come in and served as a rescue for those particular banks, and they created what was called the Bank Term Funding Program. And basically what that means is that these banks invested in all these government bonds. Interest rates go up, the value of bonds go down. That's what happened to these banks. So now the Federal Reserve and the Treasury have said, instead of your bonds being valued here, they're valued at par. They're valued here. So that's what the Bank Term Funding Program has done for the banking situation. That's why I do not believe that this will be a contagion and move into a situation where we have a big banking crisis like we had in 2008. I don't think that is certainly an option, and I don't think that's going to happen. Because of that, we've made some changes to the models. I've been doing this for over 3 decades. This is the first time I've ever seen money market rates at this level. So in our model, we're actually going to add a money market account and have that be a main piece of our fixed income portfolio. That's a very strong and safe place to keep assets. It makes our portfolios more resilient to economic change and gives us a much higher yield. We're also at a point in time where I think we've seen the majority of the downturn in the equity market. There'll still be volatility, but what happened last year and where we are now are different because we're in a different stage of the business cycle. What's going to happen in the next 6 months? I think we'll get to the end of this rate rising cycle, but GDP came out last quarter at 2.6%. That probably is going to slow. Will it slow enough to push us into a recession? We'll have to wait and see. But we're watching it, paying attention, and we'll make the right changes at the right time according to what is going on with the numbers that we see. As always, if you have questions about what's going on in the economy, interest rates, inflation, your own portfolio, just give us a call. We value the relationship we have with you. And as always, stay safe, stay healthy. God bless.